Welcome to the April 2026 monthly motor checkup. My name is Dave Lundgren, and I am the Chief Market Strategist and Portfolio Manager here at Motor Capital Management and Research. The title for this month's video is Happiness Equals Results Minus Expectations. And this is a super important concept, obviously just in life in general, but in particular in investing. I think I've got some really interesting data to share to help hopefully investors recognize how often our misplaced expectations in terms of what the market is likely to deliver can really cause us to make bad decisions and actually view volatility quite the opposite of how we should view it. And I'm speaking just strictly from a long-term investment standpoint. So we tend to go into this thinking all sunshine and roses and butterflies because that's what equities have seemed to deliver over the years. But we forget about the volatility. And when we experience the volatility, we instead of clinging to our commitment to long-term investing, we become tactical investors right at the wrong time. So we're going to talk a lot about that. And most of what we talk about in this video is tends to lean more tactically, but we're just going to take a quick moment to, this video to just speak a little bit about the importance of having the proper understanding of long-term performance and behavior so that you can better prepare yourself and your clients with proper expectations so they don't make the same mistakes over and over again. So the main thing is investors generally expect more from the market than what it has demonstrated throughout history that it can actually deliver, or that it will actually deliver. So our expectations relative to what the market has demonstrated through history that it actually does deliver are just way too high. And it's kind of mind-boggling because the data is right there. And it's not like this is a surprise or not known to anybody. This is factual data. Yet we still tend to have these misplaced expectations that drive bad outcomes. This gap between expectations and what actually happens results in poor decision making, and unfortunately, usually at the worst possible time. And the idea is that when expectations are better aligned with reality, better decisions can be made when markets inevitably get volatile because they do get volatile. And I'll show you that. I mean, you know that, but I'm going to show you some interesting stats that really bring this to light and hopefully encourage longer term investors to think about it differently, not just for themselves, but in particular for their clients to coach them to make better decisions. So we're going to walk through some enlightening stats about market behavior through history to help with this. And then, of course, we will provide a bit of a tactical update and a couple of things that we're watching as the market moves higher. So these motor zones are obviously they're very tactically oriented. And as you know, I manage a hedge fund. Half the hedge fund is committed to long-term uh, buy and hold in a specific momentum strategy that does incorporate some fundamentals and valuation. That's that long-term commitment, and that's just buy and hold. I don't touch it. I just make decisions as a stock gets pushed out of the portfolio and gets replaced with another one. I just make that decision, and I'm committed to that long-term strategy. And I when that strategy draws down, I add to it, right? So that's the concept that I'm going to talk about. But I'm just distinguishing that from what we're talking about here because I do obviously in the research I speak a lot about the tactical nature of what's going on because I think there's a great value in tactical investing as well. I think the problem is that we, as I was saying, is that we want to be long-term investors until we experience volatility, and then we become tactical investors invariably right at the most inopportune moment, which unfortunately tends to more often than not be during these drawdowns. And so I'm happy to be a long-term investor. Maybe I get my resolve tested here, but when we get declines like this, it's when we start abandoning our long-term commitment to our strategies, whether it be strategies or even if it's just passive ETFs, and we end up making bad decisions right at the wrong time. So, um, these zones are, I just want to stress again that they are intended to help those that are committed to tactical investing navigate these cycles. And so, as you know, we had our zones wearing through here when they broke, It opened the floodgates to this zone down here that was formed at the beginning of the year and didn't really get tagged until the end, as you can see here. Sorry, at the beginning of the year, but didn't get tagged until the end of the quarter. This is a quarterly zone, and so we covered quite a bit of shorts here with the expectation that we were going to put them on back up here. And of course, we got this rally. We uh, restored quite a bit of our short exposure. We basically gapped right through this zone, and having this zone as a tactical investor, knowing how important it is, like that's not uncommon that the zone actually gets respected, just as you see it here. It's actually more common than not. So knowing how important this zone is and what does the market do, it just gaps right through it. So we covered our short exposure and we're back to long, particularly on a beta adjusted basis, we're about 103% long. But all of that's very tactical and oriented investing. And so that's all very viable. It's very valuable, if you're committed to tactical investing. But all that conversation can be distracting to those who are supposed to be focused on the long term. So if you look at if you remember the discussion we were having when the tactical underpinnings of the market became a bit suspect, if you will. Again, on this tactical decline, my expectation was we would get back up into here and then potentially go down and test the new quarterly support zone, which is essentially exactly what happened in the beginning of last year. So it's not uncommon. And this is the point I want to make. If we did indeed go down and touch that zone, that'd be a 15% decline. Now that sounds like a lot, but the fact of the matter is that's almost more common than not. And that's the thing that we really need to um, let sink into our understanding of what market behavior is actually does deliver. Because if you're thinking like I want to be a long-term investor, but if you think the market's going to go down 20%, let me know so I can get out of the way of it. That's a combination of two different strategies that you can't do. And as a matter of fact, as I just said, I don't even though I do tactical investing and I do long-term systematic trend following, I don't put them together into the same strategy. Like I don't long-term trend follow as long as conditions are good and then all of a sudden I become tactical. I do both of them simultaneously, side by side, and never do the two meet or cross or intersect or try to augment each other. The two separate strategies run by themselves, running alongside of each other. And so that way that allows the tactical strategy to do what it's doing, and it allows the long-term systematic strategy to do what it's doing. So they can over time both deliver the results that they are capable of delivering without getting in the way of each other. And I think that this is the thing that we really I try to really stress with investors that are trying to be long term is don't view this as a negative something you should respond to negatively. And let's look at some numbers um, to kind of make that point. Before I get to the numbers, I just to reiterate again that the biggest mistake is that long-term investors make is that they panic when markets fall. And the idea is that you need to be clear and committed to what you're doing. Am I a short-term tactical investor or am I a long-term buy and hold? And again, you can't be both in the same strategy. As I said, I do both, but they're separate strategies kind of executed in the same portfolio. And so that's the key thing is just because things get volatile doesn't mean you should abandon your long-term strategy. So this is the market over time. This is just back to 2000, but I can show a much longer term chart than this, and I will in a moment. But the idea is that if you think that the strategy or the market is going to go higher over time, and you're given as a long-term investor periodically, you're given the opportunity to buy the strategy when it's below this long-term average return. The idea of becoming tactical in this moment in selling and trying to raise cash and get out of the way of the decline misses the opportunity to add to your position anywhere through here in a way that ultimately increases the return. Because if you're buying below this line, which is the average return, you should be almost, especially if you have long-term time horizon to before you actually need this capital. You want to spend time below this line so that you can add to it down there and increase your long-term return. So um, the idea that we get these declines, I mean, you can see several of them just on this chart alone that are not something that long-term investors should panic away from. They You should actually embrace them, almost hope for them, and so therefore change your market psyche and change your expectations. You should expect this to happen so that when it does happen, you can respond to it more properly. And if you're in this position, also encourage your clients to respond to it more properly and actually add to those drawdowns. So in this discussion, when we say buy and hold, what are we talking about exactly? Obviously, there's you can do what clearly what many folks do, which in particular in their 401k plan, is you can just buy this passive ETF. And again, when you have these opportunities to buy below the long-term average line, that should be your mentality. Um, but you can also be a long-term holder of active strategies. So these are remember, as I've said many times before, that the S&P is just another strategy. It's not the market. The market is the market. It's like 3,000 stocks and it's equally weighted, and that's what the average stock does over time, and that's the market. The S&P is although it is an index, it really is just a strategy. It's literally a committee of executives who get together periodically and say, um, let's buy this stock and sell that stock. It's literally a strategy with published rules, and so it's not the market. So to distinguish another active strategy from the S&P 500 is not much of a reach because in the end they're both active strategies. So this happens to be the back test that I use for the that systematic long-term portfolio that I partly manage inside the hedge fund alongside of the tactical one. And when I see these drawdowns, if I believe that the strategy is going to do well over time, not just beat the market, but also uh, not just go up over time, but beat the market over time, and I get the opportunity to buy this strategy below its average line, I'm frothing at the bit. That's my expectation. I expect that this strategy is going to draw down. I hope that it does because I believe in it over time. And if I'm given the opportunity to allocate more money to this systematic momentum strategy over time, I welcome that opportunity. And so the that's sort of the sea change in your mindset that you need to bring to this endeavor as a long-term investor so that you're not abandoning these great strategies right in the moment when you should actually be doing quite the opposite. You should be allocating more, and you should be getting your clients to allocate more. So let's look at the numbers of this back to the early 1900s, right? So this chart here shows you the S&P 500 back to 1928. And you see this channel is the 52-week high and the 52-week low. So you can see that it's obviously has moments of going up and down as the market's moving higher and lower. But the question is, what should we expect in the relative short term to have to endure in order to be able to capture this long-term trend? And this is where it gets really surprising, I would think, to a lot of folks. I had an inkling of this to being the case, but it was really refreshing and interesting for me to see these statistics. So 90% of the time, the market is not at a 52-week high. So that means that 90% of the time, if your expectations are that you're going to put money in the market and it's going to go up all the time, you are you're suffering right right out of the gate because 90% of the time the market's not doing that. It's actually not at a high at a 52-week high the vast majority of the time. I just highlighted the prospect of a 15% decline that could have happened, right? If you're a long-term investor and you're not expecting that to happen potentially, this is what you're ignoring. 45% of the time, the market is at least 15% from its 52-week high. So to be a long-term investor and to not expect that that's going to happen, this is the disservice you're doing to yourself as an investor, but also if you have clients and you're communicating with them on a regular basis as you're navigating through cycles, if you're not building this expectation into them, then when it comes time to uh, respond to market volatility, it's more than likely going to be the wrong response, which is to sell when you're 15% from the highs. Or, again, the market is 37% of the time, it's at least 20% below its 52-week high. So if we know we're going to do this over time, and this table is showing you that it's quite often that you're below that line, the the leap in mindset is to recognize it's normal and don't be like everybody else. If you're a long-term investor, uh, add to that investment. And what ends up happening is if you're adding during this decline, which is extremely difficult to do, no doubt. But if you did do that, your return would be increased relative to the average because you bought below the average line. So this additional statistic is just a little bit just it came out as part of the study I was doing, so I figured I'd share it with you because I think it's interesting. But this again going back to 1928, and it's just showing um, which months throughout the course of the year have the highest frequency of 52-week highs. So you can see the ones that are colored in green, January and February, are very common to show 52-week highs. July is a little bit above average. And then November and December also a bit above average. So it's the most common month is indeed January. And then over here, the most common months for a 52-week low, not surprisingly, the biggest one is September. That's the month that we tend to see the most damage. Um, but we also see, in through the middle of the summer, that whole sell in May and go away. Here you see it playing out, right? March, May, and July. So this is when you should expect weakness, and then you should expect strength in these other months. But the whole point is to change your mindset. And if you're a long-term investor, don't respond to this weakness by becoming a tactical investor. Because if you're a tactical investor, um, you should have been tactically rotating towards either cash or shorts way before you were down, as we just did. You just saw us do it in the research and in the portfolios. Way before you're down 15%, you should already be tactically allocated. The problem is that long-term investors don't start feeling the pain and the angst and the anxiety and the desire to go to cash until you're down 15%. And so then they start to act tactical when you should have been tactical already. And not only that, it's when they should start to actually buy that drawdown. So a little bit of a different mindset shift, hopefully for you here. This is obviously an age-old condition for us, humanity, if you will. Marcus Aurelius here saying, if you are distressed by anything external, the pain is not due to the thing itself, but to your estimate of it. So it's going to do what it's going to do. The market's going to do what it's going to do. Life is going to do what it's going to do. People are going to do what they're going to do. And to the extent that you are stressed by that, it's because you had different expectations than what were delivered to you. And life has no idea what you expect. Life's just going to do what it's going to do. The market's just going to do what it's going to do. It has no idea that you're in the market investing. And so to the extent that you are experiencing anxiety in the market, that's only because what the market's delivering is not what you expected. And what I'm trying to say is perhaps we should reconsider what we're expecting. Okay, so back to the original regularly scheduled programming, which is what we usually talk about here, which is tactical investing. I won't dive too much into it because I've been talking a lot about it in the research, obviously. But what I'm really focused on right now, we had our V bottom in the market. We got short on the rally, quickly covered it as we gapped right through that really important resistance. So now we're basically long. We still have short exposure on, but we're about 103 or so percent net long beta adjusted. And when you look at the leadership, it's pretty good. And when you look at it when I should say when you look at it at the sector level, it's pretty good, right? Little again late cycle. There's some defense creeping in, healthcare utilities, and there's obviously some marquee cyclical sectors that are at least at the sector level are not participating. So we have some things that it would seem that we should be concerned about here at the sector level. But there's a very prominent reason why we don't just, in fact, you hardly ever hear us talk about sectors because we don't really necessarily care too much about it. What we care about most, and it's why we created these groups, the 28 motor groups. And when you look at it this way, it's quite interesting that you have tech down here as a sector, but the the two of the leading groups are tech groups, so IT hardware and semis are up here, and then you have software and services down here. So there are so many software and services companies, and have been so weak that it drags the whole sector down here. So that's what happens if you just look at it too high of a level. Just like it's if you look at the market at just the market at the index level, you miss a lot. So you got to dig beneath the surface and look at the agents within this complex system and see how they're interacting and just kind of like suss out the truth of the matter. And when you do this at the group level, looking at these top 10 groups, I know it's man, it's just really, really hard to be bearish. So you should at least be neutral, and if you're at least neutral, then you should be long. Because if you're neutral, as I just showed you, there's nothing to worry about, right? Because most of the time the market's going higher. It occasionally does have these 15 or so percent drawdowns, like we had last year, and we potentially could have had, and we may still, and I think we still will have as the year progresses. But with the leadership looking like this, it doesn't strike me that we're on the on the doorstep of that kind of a magnitude of decline yet. And when you look at the leadership at the industry level, so just to reiterate, this is the sector level. And when you just break the sector down into groups, you can see that there's uh, three tech groups. There's a bunch of financial groups, all sectors, and these are groups. If you take the groups and break them down into industries, you get even more granularity. We have 100 and almost 180 motor industries, and these are the top 30 in terms of ranking. And I mean, it's really, really hard to not be bullish when you see leadership like this. Remember, the ones that are blue here are the ones that we're actually going on almost a year now that I began highlighting these as blue on the premise that I believe we were beginning the beginning stages of the hype phase of a bubble. I think it's possible that this war has kind of disrupted it a little bit, but obviously hasn't derailed it. It just kind of maybe caused a few corrections more than might otherwise have happened, and so therefore stalled it a bit. But nonetheless, most of those blue groups that I identified as being hype leadership type name groups are right there in the hunt in terms of the leadership. The only group that's defensive, or the only industry that's defensive, is here, the fuel tankers. But we know why that's obviously happening. But beyond that, it's yes, there's some late cycle, but it's very, very growthy, very hype, very risk on, if you will. So when I look at the leadership, which is a key critical uh, attribute when you're defining the regime, this is just it's too bullish for me to be anything but bullish structurally. Okay, so then here's a few things we're looking at as we kind of work our way into the second quarter, and then eventually on into the third quarter of the year. I highlighted this chart last year at some point where what I was trying to highlight was down here is the green line is the Fed funds rate. And I've always said that if you want to know what the Fed is going to do, just follow the 2-year note yield, which is this blue line, because the Fed tends to follow whatever the 2-year note yield is doing. So the 2-year note yield will peak before the Fed moves, and the 2-year note yield will bottom before the Fed moves, and we saw it again here, right? The 2-year note peaked in here, and then later the Fed turned down. So that's a key sort of macro indicator that we watch. Then with COVID happening, this relationship that you see up here really became a really important signal unto itself. Prior to COVID, it was pretty much a flat line. And so what we're looking at here is two versions of small caps. We have the S&P 500, S&P 600 small cap, and the IWM, which is the Russell 2000. So these are, generally speaking, they're all small caps, but the S&P 600 small cap actually has a quality metric that's required in order to be included into the index, whereas the Russell 2000 doesn't have that. So you could almost say that the Russell 2000 is the junk small caps. And so if this is the high quality small caps relative to the junk, when the when the high quality small caps are underperforming, you're in a bull market. And when the high quality small caps are outperforming, then markets are hunkering down for a risk off scenario. And what I found particularly intriguing about this is that and so far it has been working out this way, where the equity market, for all the talk of fixed income, the fixed income market being really smart, or smarter than the equity market, is that this relationship not only turns higher before the Fed funds rate, but it's also turned higher before the 2-year note yield. And so that was critical here because it turned higher here first, and then the 2-year note yield turned down, and then the Fed funds turned down. And here we want to point out that the quality small caps have been outperforming since the latter part of last year, which dovetails, of course, with the beginning of the conflict, and now I guess arguably potentially war in Iran. So maybe there's a bit of a risk-off element to that. But we're now starting to see the 2-year note yield turn up as well. So there's a potential message here coming from the market that the Fed should be considering raising rates. Now, whether that holds or whether it sticks, or the Fed even cares, it'd be interesting with the new Fed chair, who's obviously going to be in there with the expectation that he's going to fulfill Trump's wishes and lower rates. This is saying that there's a potential significant risk should he go down that path. I'm also keeping a very close watch on these credit spreads. So this was one of the indicators that did a really great job for us early in 2025, getting short, and then here again, this whole divergence here, where the stock market peaked here. So if the market's up here, the market peaked into early 25, and then has since done this. With the S&P out to new highs, these credit spreads are nowhere near their lows at the triple. This is the triple C, sort of junk credit. So this is pretty alarming. So we can see the credit spreads have been coming in, both for the triple C, with the junk, and then the more investment grade credit spreads finally began to turn higher as the market turned down, but they've come in quite a bit as well. So this is at the margin. It's a good indication, but it's still far from being having resolved this divergence that's still very much in place. So I think this will be, of the things that we're monitoring outside the equity market, I think this is one of the most important ones. And we're seeing a lot of this discussion about how the University of Michigan consumer sentiment is at the lowest level it's ever been at, with the stock market at the highest level it's ever been at. And the question is, what's going on here? And it is kind of shocking. Here's a chart of it here, and here's the consumer sentiment, Michigan consumer sentiment. I mean, the sentiment was here at COVID, and then of course it plunged down to what was then the lowest level back to the 1980s, and now it's back down there again. And all of that is happening with the S&P at highs, at all-time highs here. And so it's clearly, when the S&P is doing well, you tend to have high sentiment, right? S&P doing well, you have sentiment way up here, but instead we have quite the divergence here, and this is really kind of puzzling. The only other time we can point to it on this chart where this has happened before, where we had sentiment doing this while the market did this, was oddly enough back here. And that was the last inflationary cycle. And so, not to say that we're necessarily in an inflationary cycle, but certainly not of the magnitude that we experienced back then. But nonetheless, it is really is the first sort of inflationary surge that we've had since then. And so it is interesting that that is happening, or at least the last time some variation of what's going on today happened was back in the late 70s, early 80s. So if it's perhaps an inflation thing that's kind of driving this disconnect between sentiment and the market, we can look at that, right? So let's look at the S&P 500 adjusted for gold. Now we're starting to see something that's coming together a little bit more sensibly. Here we see that S&P relative to gold plunging with sentiment, right? So remember, on the first chart, they moved opposite each other here, right? You can see the S&P moving higher as sentiment was plunging. But if instead we adjust the S&P for gold, we're now moving in the same direction. So now we have something that's, it's a little bit more in line with what we're seeing today. Okay, so this is starting to make a little bit more sense. These are moving together a bit more, but it's still not quite as at anywhere near the same level. One of the things that's been happening is and I've been talking about this for years now, is this, and so not to say that I'm the only one that's been speaking of it, but it's this concentration of the index and these mega cap companies that are driving the S&P higher. And I've been pounding the table on this notion that we need to also follow what the average stock is doing. And so when you take the average stock and you adjust that for gold, which is this blue line, now it seems like the puzzle pieces all fall together, and now we can get a sense for what's actually happening because the the um, the average stock has really been going sideways for 3 years. And that dovetails with the very poor economic environment that we're in. And that spills over into consumer sentiment and the average experience for the average American. And so, what this chart is showing us is that the reason the average American feels in the dumps from a sentiment perspective is just because it's been a quagmire of an economy. Now we have it, but with the potential for an inflation headwind and everything else. Now you take the average stock and you present it adjusted for gold, which is adjusted for inflation, at least one way of doing it. Now we see the picture come together a lot more clearly. So this actually makes a lot of sense to me that sentiment is way down here. So is it feasible that from here we have a big secular structural bull market? I mean, anything's possible, but I'm not sure I'm making that call. I certainly don't have the tools to make a call like that. But I can say that at least the way this is right now, it makes a lot more sense to me that sentiment is down in the dumps where it is when you reflect the market properly, which is to show that it's been in a bear market for 3 years and it now has that inflationary headwind. So hopefully that at least provides a different angle for understanding what's going on with consumer sentiment. That whole notion of how I just walked through the consumer sentiment, been in a recession for 3 years, but mega caps and you have this sort of K-shaped economy that's resulted from this divergence between the big mega cap hyperscalers sucking up all the capital, sucking up all the profits at the expense of the average company, which spills over into the average American. So we can one of the things that we know as well is in terms of stocks that have been doing well for the past 3 to 4 or longer years has been the luxury stocks, and that makes sense in this sort of K-shaped economy. The companies that cater to the parts of the or the segment of the economy that's doing well, these luxury companies have done better, right? So this will be something to keep a very close watch on. So when you look at the risk gauge, which is updated for tonight for the end of the month, I was surprised that it didn't pop into risk on, but it's very close, as you can see, green, green. So it's very, very close. Perhaps we'll see that pop in there towards the end of the week here. But nonetheless, the point is, and it is kind of this is kind of the important point is that we've been struggling to get out of this mixed zone, and we're still struggling, right? We're with the S&P trying to break higher and potentially the average stock, we're still struggling to do this. That's emblematic of the environment we've been in for the past 3 years. But when you look at the risk gauge on the what we call the Motor Luxury 50, this is an international index, all in US dollars. That longer term risk gauge is up here at 2. And that underscores the idea that this luxury index has been doing really well for a long time. But look at what's happening here. This might be something important to watch going forward. The medium term monthly time frame risk gauge is hovering just above the middle of mixed, and with the risk gauge up here at 2 in the short term for the average stock, the short-term risk gauge is at a 6 for the Motor Luxury 50. So I think going forward, uh, one potential bullish resolution would be that small caps do really well, the economy broadens out, sentiment turns higher, drives stocks higher, the average stock, and this finally goes into risk on, while this, along with the Mag 7 and other representatives of the sort of K-shaped economy, that have benefited in this K-shaped economy actually start to do poorly. And so this will be something to really watch going forward as well. So in summary, so the just as a reminder, the biggest mistake that the long-term investing investors make is abandoning their long-term plans when markets get volatile, and instead switching to a tactical investing strategy almost because it makes them feel better, like they want to get out of the way of the weakness, almost invariably at the worst possible moment, and it has to do with expectations. So if you expect volatility instead, you'll be ready for it and you'll use it to your advantage. And so this also includes allocating not just to passive strategies, but also to active strategies. So obviously, if an active strategy is in a drawdown, you're going to want to study it, make sure you understand why the drawdown is happening and that there's nothing wrong with the strategy or the manager's not misexecuting the strategy. But if you can get through all of that and identify that the strategy is fine, treat that like a drawdown on the market. And you should expect a strategy to draw down. You should not expect it to be hitting all-time highs all the time. That's just not how it works. Trust me, I can tell you, it's not how it works. So when you have an active strategy that you've bought because you think you've invested in because you think it can do better than the market over time, that doesn't mean it's not going to draw down. So stay committed to that strategy and add to it during drawdowns. That'll actually, in the end, improve your long-term return because you're buying and accumulating that strategy during drawdowns. So, for those that are committed to tactical investing, which again is half of the hedge fund that we manage, I can just say that we've just put in another V bottom, just like we did last year. And with that, we are basically 103% beta adjusted net long. And for going forward, we're just keeping an eye on that leadership. It's still very bullish, very cyclical. Granted a bit late cycle, but that is what it is. It's not bearish. It's just descriptive of where we are potentially in the cycle. Close watch on credit spreads. That 2-year yield is the Treasury market telling the Fed that they might need to consider raising rates, and we're seeing something similar from the junk small cap relative performance as well. So that's something that we're going to want to watch going forward, as well as how this global luxury brands index and risk gauge performs going forward as well. Just to summarize, though, structurally, we remain bullish. Our thesis remains that we are going to continue to see higher highs through 2026. Tactically, we did think that we could get before that pullback was over, we could get up to a 15% decline. Obviously, that didn't happen. That's part of tactical investing. So we abandoned that quickly. We actually did well during the drawdown, and we've recovered quite nicely since then. And so all of that, however, didn't dissuade us, as we wrote at the time, from our longer term tactical view that we still have higher highs coming as 2026 gets into the second half of the year. And we think that the IPO cycle, which is only just starting to get going again, is going to be one of those things that kind of feeds the animal spirits. We still have the tailwind of all the legislation that's passed and being passed. And very perversely, I believe that the midterms will actually be a good thing for the market this time, not as opposed to the typical, the midterm is political midterm, presidential midterm tends to be an overhang for the market. I think it actually has a potential to be a positive because of what the president will do to try to preserve the uh, the Republican edge in Congress. And so all of that's a lot of forecasting. It's a lot of discussion. It's a lot of blah, blah, blah. But, it may or may not happen, but that's what I'm thinking. And I believe that because that's what the data is saying right now. And then if it all plays out, it would be my expectation that sometime in that latter part of the 26 is when, if we're going to have something to really truly worry about beyond 15%, that's when we'll see that kind of weakness. But let's one day at a time, and let's see how we get through the next few months here. Thanks for watching. As always, I appreciate you taking the time to dial in with us again this month. Please reach out to me if I can help with anything, and looking forward to speaking with you again next month. Thanks so much.